Thank you for joining me for the latest in my Ask Me Anything webinar series. This session is Living Longer. What does it mean for retirement planning and your portfolio? So the topics we're going to focus on today are the importance of making financial planning a joint effort, maximizing Social Security benefits, working longer, talk a little bit about long-term care insurance, some tax implications of all of this, and then how it all interacts with your portfolio. I did receive a question in advance, and I will address that at the end of the regular part of the presentation. So first, let's just take a look at life expectancy. This issue about longevity is particularly relevant for women because, as you can see from the table, they live longer. On average, it starts out at about 4 years, but you'll notice that once we get to 50, that gap starts to narrow. And by the time you're 90, it's very close, it's less than a year. So as we age, men and women look to have the same similar life expectancies, but certainly at other stages they don't. And the other thing that also matters here is more often than not in a couple, the average age difference between the husband and wife is about 2.5 years. So that does magnify this a little bit. The end result of all this is about 90% of women are going to end up on their own at some point. And this data comes from the life expectancy tables provided by the Social Security Administration. So here's some of the risks that come and why financial planning should be a joint effort. There's a risk that you outlive your assets. And so certainly you start as a couple, but one person ends up by themselves. And that's an issue because that increases the odds that that person outlives their assets. A loss of a spouse is a risk for a couple reasons. One, loss of a spouse means loss of income. Two, loss of a spouse means a change in tax status. Three, a third reason would be that when you think about it, a lot of times when you have a couple, if one gets sick, the other one takes care of that person. And if that first person passes, if the second person gets sick, there's nobody left to take care of them. So their care becomes more expensive. And that's the healthcare and medical expenses that I'm talking about there. And then inflation is another concern because over time, our purchasing power gets to be less. And that means if you have certain elements of your income that are fixed in value, your purchasing power is going to decline over time. But oftentimes what we have happen is one spouse will take care of financial matters, but the decisions, they need to be made jointly. Remember, if your spouse is taking care of these things, it's your plan too. You want to stay plugged into your family finances. One of the biggest issues that you can have is you want to make sure that you can access your spouse's accounts if they're gone. It means you want to have a password book or have an online account through a service like LastPass. I know when I get a new client, they get a password book from me just to help you with that and stress the importance of it. It used to be that if somebody died, you would get the mail and you look in the mail for statements to figure out if there were any accounts that you didn't know about. But that doesn't happen anymore because most of the brokerages and banks don't send statements anymore. They send you them electronically. So if you don't know how to access the accounts and don't know they exist, it may mean that you have assets that you can't find or don't know are there. We want to maximize Social Security benefits. That's a big thing. You want to consider when you're deciding when to start claiming Social Security, you want to consider the short term and the long term. And remember that for a couple, the joint life expectancy of a couple is greater than either individual's life expectancy on their own. So if you have a couple and one, especially when you have one that earns more than the other, ideally, if you can, you want to wait till that older spouse makes it to age 70, because at age 70, that's your maximum Social Security benefit. For those born in 1960 or later, full retirement age is 67. Your benefit grows from 67 to 68, 68 to 69, and 69 to 70 at 8% a year. So that's like a guaranteed return that you can't get anywhere else. So that's another reason to do it. And second of all, If you get that one spouse that gets that higher benefit, that maximum benefit, well, remember that when one spouse passes, the surviving spouse gets the higher of the two benefits. So if you can fully max out that one spouse's benefit, that leaves the maximum amount of Social Security income that you can leave for the surviving spouse. I know that I had somebody that I talked to that did not become a client, but the difference between husband and wife was more than 10 years. And when he hit 67, he was in a hurry to take Social Security. But especially with that kind of age difference, that's not the kind of decision that you want to make on Social Security. He should have clearly waited till 70. He was the big breadwinner in the family. He was still working. And by starting at 67, that means that when he's gone, which is the likely scenario that he'll go first because of that difference in age, that her Social Security benefit will be a lot less. And so it was take some money now, but it was at the expense of giving away a lot of money later. Your full retirement age, if you're born before 1960, well, if you're born in 1953 or earlier, it's 66. And there are some special rules around collecting benefits. If somebody was born in 1953 or earlier, there's a special spousal benefit where the one spouse can take half their spouse's benefit and then convert to their own at age 70. But that no longer exists if you're born after 1953. From 1954 to 1959, your life expectancy increases 2 months per year. And the break even for waiting from 67 to 70, it's around age 81, 82. So again, and that's not just for one. If there's a couple, that's it. Either one of you gets to at least 81, 82. So that there can be a huge benefit that comes with waiting. So how do you do that? How can you wait? Why should you wait? Let's look a little bit about what that does for you. So first of all, if you stop working in your 60s at some point, and you don't take Social Security, you don't have that income. Well, you can use your tax deferred savings. If you take some money out of your retirement account at that point, well, you're actually going to lower the balance of your retirement account, potentially pay less tax on it today. And when you get to age 72, when you have to start taking distributions, you'll have to take less because you will have taken some money out of the account. So it reduces the size of your future RMDs. Also, if you space out the income that way and don't have a full RMD, based upon your retirement assets, a full RMD, plus your Social Security, that can also potentially have a positive impact on your IRMA, which is your income-related monthly adjustment amount for your Medicare payments. So it can reduce your Medicare costs a little bit. It can provide long-term tax benefits, again, because if you wait, also there's the issue, which we'll talk a little bit more about later, that you're a couple, and you're filing a joint tax return. And therefore, there's some tax benefits that come with lower rates when you have two people that are combining for the income instead of one. And as I said on the last slide, your Social Security benefit's going to grow. It grows 8% a year from full retirement age to 70. It also grows, and you can start taking Social Security at 62. And from 62 until full retirement age, your benefit does grow every year, just not as much as it does once you hit full retirement age. Something else to think about is long-term care insurance. Now, I'll tell you that many of my clients don't use long-term care insurance, but it doesn't mean that you shouldn't look at it. When we do a financial plan, we consider long-term care insurance. We look at it, we see if it makes sense, see if you want to self-fund versus get insurance. It can make sense to get it for the spouse that's more likely to be the survivor. Because again, if we go back to that earlier scenario, first spouse gets sick, they pass. Second spouse, now if they get sick, unless they have kids that can come back and take care of them, they may not have anybody to take care of them, so they may need that coverage even more. So you can self-insure, but you want to evaluate in context of your full financial plan. It can provide benefits. There are ways that you can get like a hybrid type policy. And what I mean by that is it can be a dual policy where if you never take the long-term care benefit, it does have a life insurance benefit that can go to your heirs. In general, when you think about any kind of insurance that revolves around your health and your life, the sooner you get that insurance, the better, because you're really never going to be healthier than you are today. Over time, our health deteriorates so that your rates are going to be lower. If you start now, you may pay premiums for longer, but that should be offset by the fact that you're going to pay less. And you can also think about getting a joint benefit policy, where if you have That policy can cover either, there's a certain amount of coverage for either spouse, but one can use more of it than the other if it's needed. And then if you have a legacy goal, leaving money to your kids or your grandkids, whatever the case may be, long-term care insurance can make more sense because it's a way to keep you from depleting your assets and leaving more for your survivors. So let's just take a little bit of a look at tax rates. So the first thing is that I know there's talk about potential tax legislation now with the changes in Washington, but we don't know what's going to happen. So all we can do is go by what we have today. And what this tells us is, what we know today is that in 2021, we have the rates that basically were set when the 2017 Tax Act passed. They go up a little bit each year, but those rates sunset at the end of 2025, which means that as of 2026, we're going to go back to the old rate system. So absent any further changes, taxes are going to go up in 2026. For a single filer earning $100,000, the tax rate's going to go from 24% to 28%. A married couple with that same amount of income, $100,000, is going to see their top rate go from 22% to 25%. A married couple earning $160,000, for those earning $160,000, singles are going to go from a 24% rate to a 28% rate. And a married couple is going to go from 28% to 33%, I believe it is. Yes. I'm sorry, they're going to go from, they will be, a married couple is going to go also do the same, 24 to 28. So you just want to think about what the rates are. And, when you remember too, that if you pass, now your spouse is going to file single. So some things that we can do to accelerate income during that period when the couple's married, there's advantages to that for the long term, because it's going to mean your spouse is going to pay less, and potentially your heirs are going to pay less too, depending upon how they get money that's left behind. That's if there is any. Some people want to their goal is to leave nothing behind, but some people do want to leave something for their kids or their grandkids. So let's look at some of the important tax and income considerations. So, like I said, there's single versus married rates. There's Roth conversions, which I talked about previously. If you do Roth conversions, the nice thing about those is while you pay some tax today, once the money's in the Roth, you don't pay tax when it comes out. And under the rules that passed, the Secure Act changed the rules on inherited IRAs. Now you only have 10 years to take money out of an inherited IRA. That can cause a big tax problem for your beneficiaries, not your spouse, because your spouse kind of steps into your shoes for the most part. But again, for your heirs beyond that, if you have money in a Roth account, then your heirs don't have to worry about those tax implications. One thing that somebody reminded me of that I know, but I haven't stressed, is you want to do Roth conversions, they come after your RMDs, because the government, they know that you didn't pay tax on this money. They want you to pay tax on it at some point, and they won't let you double up and say, well, I'm just going to take my RMD and turn it into a Roth. If you want to do Roth, you have to take out more. The other thing to remember too, as you think about all this, is that Social Security income will fall when there's only one spouse. Like we said, the surviving spouse gets the higher of the two benefits. And if there are any pension benefits, they may decline, they may not. That's going to really depend upon how you set up that pension, what elections you made when you took it. So how's all this impact your investments? First of all, know your time horizon. And when I say that, there's lots of different time horizons that we consider, because it's going to depend on your goals and your objectives. There's your own, in terms of how long you're going to live. And so we think about, as we get to retirement, that we want to become more conservative. We do, but we also want to be careful, because there's something called longevity risk. And that's the risk that we outlive our money. So we don't want to get too conservative as we approach and get into retirement, because if we don't get any growth from our portfolio, that could mean that we increase our chances to run out of money. Also, I have some clients and some people that I work with that their goal, their portfolio is large, and they don't want to their goal isn't to spend all the money. Their goal is to leave something behind. So if you're doing that, think about the future generations that might get the money. And that again is an argument to say that I should be allocated a little bit more aggressively, because of the fact that the time horizon of those who are going to use the money is much longer than my own. The conventional wisdom has always been that as you approach retirement, you lower your allocation, keep it there. But I've read a lot of studies, and something that I think a lot about and talk to people about is the idea that you can lower your allocation as you approach retirement, because we're worried about something called sequence of return risk. Sequence of return risk is we know that the market's not going to go up every year, but we don't know when it's going to go down. The worst time for the market to go down is in those first years or after retirement. Why? Because your portfolio goes down, you're not adding any money, and it's a lot harder to recover because you still have years left. So the idea is get conservative as you approach retirement, and as you start to move away from retirement, as you need cash, instead of selling your stocks, sell your bonds. And that way, that has the effect of increasing your stock allocation and reduces your chance of running into longevity risk. You want to be careful about carrying too much cash, because cash, it's a wasting asset, right? Because we have inflation. I know we hear inflation isn't that high from the conventional numbers, but I'll tell you, there's a lot of things that you can go buy and they cost more money. And sometimes we don't realize it because they've shrunk. The size of the package has shrunk and other things like that have happened. But prices are going up, and it's sometimes we see it, sometimes we don't. And some goods they don't. But like if you go to a grocery store, it costs you more money than it used to. So you want to make sure that you can stay ahead of inflation, because otherwise it's going to hurt your purchasing power. And when I answer the question that came in, I'll talk about that a little bit more. A 2017 study by Merrill Lynch found that 52% of women feel confident in managing investments compared with 68% of men. So that lower confidence level can lead women to defer financial decisions to their partner. That can cause problems if you get a divorce or your partner dies. So again, that gets back to the point I made earlier. You want to make sure that this is a joint effort and not a silo, not siloed. If your spouse dies, your income's going to likely fall. So take care of your financial future. Learn some key financial skills. Know what's going on. Be informed. Women are also sometimes more hesitant to invest. This can result in higher cash balances and increases the likelihood they're going to face a shortfall in retirement. As I said, cash loses buying power over time because savings rates are not high enough to keep up with inflation. Investing can potentially help you grow your money so you can outpace inflation. So advisors should be encouraging women to invest early. And if you're not comfortable doing this on your own, consider hiring a fiduciary advisor. You want to hire a fiduciary because it's somebody that's going to work in your best interest, and it's somebody that's not going to be compensated for selling you products or anything like that. It's really only going to be compensated for providing advice. In general, excuse me one second. There's three types of investors. There's those who need help and they get it. There's those who need help, but they convince themselves they don't need it. And then there's those who can handle everything on their own. Most of the people that I work with are going to fall into that first group. Those in the second group, oftentimes all they're really doing is procrastinating. Those in the third group, they can do at least some of this on their own. But remember that doing this on your own requires combining investments with tax considerations. Doing that kind of analysis can be tough. If we're working on our own situation, we've likely never done it before. So we're practicing on ourselves. I spoke to somebody yesterday that told me that he had bought some individual stocks in his accounts, which was a new prospect. And he said, oh, well, the market fell. So I sold some of those and I bought them and put them into my IRA account instead. I asked him if he knew what a wash sale was. He didn't. He thought he had small gains, maybe losses. The wash sale rule says if I buy a security and sell it at a loss, I can't replace it with the same identical security for 30 days. If I do it within that 30-day period, that loss is suspended. I can't recognize it. So instead of having like a small gain, he had $100,000 of gains. I also read a story about GameStop that talked about somebody that because of GameStop, they started day trading. They had a small account, less than $100,000. And they thought that they had $45,000 of gains. They went to do their tax return and found out they had $800,000 of gains because they had so many disallowed losses under the wash sale rules. So you have to be careful. Make sure that you know what the rules are and what you're doing before you just want to venture down this road and make a mistake that could be really costly. Other reasons that people start to work with somebody is maybe they're experiencing a life event. it can trigger an I need help kind of reaction. A lot of times I talk to people and they're worried about their spouse. One member of the couple is taking care of things and is comfortable with it. And it's not always the man. I mean, I was talking to one of my clients yesterday, it's a woman, and she's like, I got to make sure that my husband's involved in this because he doesn't know what's going on. And I'm worried about what happens if I'm not here. What's he going to do? What happens if you go first and then your spouse is really in trouble because they don't know what's going on? So make sure that you work together. Perhaps you're just tired of doing this yourself too. You want to reduce the stress in your life, or the decisions you must make, they've outgrown your comfort level. If any of those things apply, I'd be happy to schedule a no obligation conversation. Just in general, my business is growing. I'm always looking for new clients. One of the ways it grows is through personal introductions from people that we know and serve. As you think about who you could introduce to a prize, here's some things to look for. I like to work with people who are interested in gaining a better understanding of when they can retire and what retirement might look like. I call my process the pathway to an informed retirement. It's meant to take you from point A, where there's a lot of retirement uncertainty, to point B, where you have a more informed vision of what your retirement could be. Oftentimes, people I work with experience a life transition, such as retirement, loss of a spouse or parent, divorce, sale of a business, a major career change, or an inheritance. I definitely like to work with friendly people. I like to get to know my clients and have conversations and learn more about them and their lives and what matters to them and what doesn't, so that we make sure that that's reflected in the work that we do. Because of my background, people that I work with are often concerned about income taxes. They're receptive to professional relationships. And they're considering simplifying their life by delegating their financial affairs to a professional. You can give me a call at the number here or send an email to arrange an introduction. And if you do, I appreciate it. Thank you. Here's a link to my calendar, and you can get on our distribution list. I'd be happy to schedule a call to help you go through any questions that you might have on this topic. So I'll also take some questions in just a second after I go over the one that was sent in ahead of time. So I was asked to talk about how big a factor inflation is in evaluating whether to purchase something like an annuity. The person said that it was too late for them, but they have a fixed annuity that pays the same amount of money every month. Now that provides security, right? Because you know that money's going to be there every month. But then there's a second guess that comes with how much inflation is going to reduce the value of that payment. Is that a mistake? I mean, first of all, I will tell you that I don't use a lot of annuities because there's a lot of costs with them. There's some other things that I think you can do instead. But there are, some people, because of their risk tolerance and things like that, annuities do make sense. And you want to make sure if you're doing that you work with somebody that doesn't have the really hefty fee structure. So when I work with somebody for an annuity, there are insurance agents that work with fee-only advisors, and that means that costs you or less. But if you look here, what I did is I showed 3 different inflation rates, and we know inflation right now is viewed as being low. So let's just see, if we had inflation at 2%, so that's the middle set of boxes here, and you collect from your annuity for 20 years, say your benefit under this annuity was $500 a month. In today's dollars, you'll see that was only worth about a third of what it started out at, because of the fact that you see it was worth $334. So that's about 2/3 of the starting value, or 1/3 less than you started with. And that's just because at 2% a year, that's how much the value of your income falls from a purchasing power perspective. At 3% over 20 years, now you're talking about a 45% decline in purchasing value. Even at a 1% rate in 20 years, you've got a 20% decline in your purchasing power, because it's at 409. And then as you go longer, you can see that those numbers increase. At 3% over 25 years, the value of your income stream is half. The moral of this story is you don't want to hold too many investments that have little to no growth potential. That increases the chance that you're going to outlive your assets. The other side of the equation is having a certain amount of fixed income can allow you to be more aggressive with other parts of your portfolio. So you want to make sure you have a good balance. I'll tell you that from an asset allocation perspective, everything that I've read says that your minimum allocation to stocks should be 20%. Now, that's really low, but you shouldn't go below that because it doesn't really provide any additional diversification value. And that's it for, for the formal presentation. I'm going to unmute you, and if you have any other questions for me, you're welcome to either ask me those questions or to send it in the chat, whichever you prefer. And I'll allow a couple of minutes for that. Right. If you don't have any questions, I don't want to keep anybody. If nobody has any questions, then I will go ahead and stop here. And I want to thank you for joining me today.
Phil?
Yes.
I have a question.
Okay, go ahead.
Okay, you said in your presentation that don't have too much cash. I think you said it's a wasting asset. How much cash is too much? I mean, can you give some for instances?
Absolutely. So when I have a retiree, what I do, Francie, is I think about, I look at what their income in the portfolio provides. We've done a financial plan, so we have an idea of what they're going to be spending. And let's say, I'm going to give you an example. Let's say that your expenses are $5,000 a month. So that's $60,000 a year. I think about the fact that historically, when we've had bad markets, they come back in the 18 to 24 month time frame. So I kind of use like a bucket strategy, and I say, let's take in this example, $90,000 to $120,000, and that's going to be in cash, short-term bonds, CDs, something that's pretty liquid that I can access. So if we have that bad market, I can, and I'll adjust that too. Let's say that my portfolio had income, right? It provides dividends and things like that. And let's say it provides $20,000 a year of income, my portfolio. So now instead of needing $120,000 a year, I say I need $100,000 a year. And so like I'll take up to $200,000, and that's going to be my cushion to protect me. So if I have a bad market, I draw on that cash so that I don't have to sell my assets at depressed prices. And then the idea there being that then when the market recovers, I raise cash by selling those assets at a higher value. That's typically how I try to look at it.
So in that example, you're saying about 200,000 in something that's liquid?
Yes.
Okay. Thank you.
You're welcome. Any other questions from anybody? If not, then I'm going to say thank you for joining me today.
Bill,
yes.
can you hear me?
Yes.
Do you think that the tax laws are going to change on the way money has to be taken out of an IRA? Out of an inherited IRA, I should say.
So on an inherited IRA, I don't, since that's like not one that I think that they're going to try to go after, because they just did. Right? Because the change that they made was pretty substantial. It used to be that they had a stretch IRA, and what that meant is that the beneficiary, if it wasn't a spouse, they could take that money over their remaining estimated life.
Right.
Cycles. And so like if you had 25 years in year one, you take 1/25th. The next year you take 1/24th, and so on down to year 25, it's all gone. When they changed to the stretch IRA rules that only gave you 10 years, that was a revenue raiser. So it seems unlikely to me that they would make a change that would do much to that, because they've already tried to raise more revenue out of it. And I feel my own sense is that doing it faster than that would be, making it any faster than that would just be too onerous on the people that are on the other end. So I feel like that 10 years is probably going to stay.
You know, what about the required minimum distribution? A lot of people are still working or part-time work after 70 or 72 or something, and that really raises your income tax a lot if you have to pay tax now on this new income that you're getting, that you have to take out.
So you're talking about, Susan, you're talking about on the inherited IRA piece or your own?
No, on just the regular IRA, the required minimum distribution.
Okay, so if you are still working, so that first of all, the age is 72, anybody that hasn't started yet. If you're 72 and you're still working and you don't have, I believe it's a 20% ownership interest in the company that you're working for, you don't have to start taking your IRA, your minimum distributions till you stop working. If it's your own company, then that doesn't apply and you have to start at age 72. But if you're working for somebody else at age 72 and your money is in their plan, so that's the other thing, you have to move their money into their 401k plan or their 403b plan or whatever they have. If it's in their plan and you're still working for the company, your required minimum distributions don't start till you stop working. But if you can't do that, then yeah, that can be an issue because you're going to have to take your R&Ds and you're going to have your salary. So that's how you have to think about. One of the articles that I'm sharing in tomorrow's blog talks about ways to minimize your distributions. So that's why like Roth conversions properly timed can help. If you're charitably inclined, a qualified charitable distribution can help because that money, if you take that as part of your RMD, you don't pay any tax on it. You don't get a charitable deduction for it, but it's actually more advantageous the way the QTD is structured in that you can just take it directly, send it directly to the charity and you don't have to pay any tax on it. That's if you don't need the money, of course. If you need the money, that doesn't help you. But the reason the rules are set up this way is they don't want people to just park money into the IRA and never pay tax on it.
That's what I was hoping to do. Thank you.
You're welcome.
Phil,
Yes.
I was wondering, I saw the MSIG presentation a while back about Roth conversions, and Roth conversions are my main issue. I was wondering if you think, right now the tax brackets that we currently have are supposed to expire at the end of 2025.
Correct.
So that gives us several years with these advantaged brackets. Do you think the brackets under 400,000 are going to change before then? Because, maybe this isn't a fair question, but it's a big worry to me about how quickly I get money out of my old 401k, which is.
You go in the garage?
the
Would you bring me in a
traditional
bottle
part.
of seltzer, please?
I'm sorry, go ahead, Rich.
Anyway, my big worry was getting it out of the traditional part of my old 401k.
Mhm.
And I got a lot of money in there, and I've been bracket stuffing to the 22% bracket, but I've been thinking about maybe I should go considerably higher. And I have been wary of doing that just because Medicare B payments go way up.
Right.
And of course, maybe that's in the big scheme of things, maybe, that's like being worried about being hit by lightning. It's just, one of those things you worry a whole lot more about it than it's really an issue. Do you think those brackets may change earlier?
So it's first of all, I think I've said before that I worked for Deloitte at the start of my career, and every year there was talk about tax legislation, and every year the firm would put out all this, all these think tank pieces about like what to do, and then the legislation wouldn't pass. But so I try not to forecast too much about what rates are going to do. But I know that the pandemic has caused, our government spent a lot of money on the pandemic. And it feels to me like they're going to want to get some of that back. And if they do, higher tax rates seem like they're coming. I will say that a lot of the things that I've read, and I know you use that $400,000 figure, and it feels to me like that might be something that they do, is that they could leave it alone under 400, but do something over 400. Because like one of the solutions that they've talked about to help fund potential Social Security deficits is to stop the Social Security tax where they have it now, but then reinstate it if your income goes over $400,000. So it seems like that's kind of viewed as some type of magic number. It might not be that number exactly, right? It could go a little bit up or down, but it feels to me like there's at least a reasonable chance that we have this system where the gap or the tax burden that's put on people with a little bit higher income is going to be, it's going to be a wider spread than we have now.
Okay, thank you.
You're welcome. All right, I assume that's it. So I'm gonna stop here and thank you guys for coming. And next month I'm only gonna go to monthly starting in April. It'll be the fourth Thursday of the month. And in April, I'm gonna be speaking about Social Security as the lead topic. Thanks a lot, everybody. Have a good night.